Welcome, Accounting Boffins. You are with Ashraf Patel and the crew, guys. Remember, we are taking you on a journey where we're going to analyze a projected income statement. So the topic that we are dealing with, obviously, would be our budgets. Remember, that's the section that we're dealing with on the budgets. We looked at, in previous lessons, we looked at the cash budgets in detail. Today, we're looking at analyzing a projected income statement. Remember, what is expected of you in the exams? You are expected to draw up a cash budget with all its components, right? For example, the debtors collection schedule, the creditors payment schedule, and all of that will fit into your cash budget, and you are expected to draw up a projected income statement, which we've done already. And more important, right, is the analysis and analyzing of a cash budget and a projected income statement. So, the question that we have to answer is, what is a projected income statement? Remember, it is used to plan and predict the amount of profit the enterprise will generate through its future operations. By doing what? By looking out for the estimated incomes and expenses for the forecast period. So, let's put that in a summary form. Your projected income statement projects the future. It forecasts future incomes and expenses, where we compare the two to determine whether we have made a profit or a loss for the budget period. Okay. What's the importance of your projected income statement? Remember, when you are analyzing the budgeted income statements, management can ascertain whether, one, the business will be profitable over the budget period. So, ultimately, you want to know from your projected income statement, will my business be profitable over the budget period? And that's the purpose of a projected. Now, understand something. It is a projection. You are forecasting what will happen in the future. And like I said in the past, and I'm saying it again, it is based on evidence. It's not thumb-stuck figures that we just clutch out of the air and we work on them. No, it is evidence. That means we look at historical figures and we look at future scenarios, and based on that, we then plan and prepare for the future. In this particular question, we are provided with a partially completed projected income statement of Zanele stores prepared by the bookkeeper for the period 1st September 2020 to 31st of October 2020. The business is owned by Zanele Zwane. Okay. What are we required to do? We are expected to calculate the missing amounts that are marked A to D in the projected income statement. Right, let's start with the first one. In the first one, we can see that we're given the bottom half of my projected income statement. So I have my net profit at the end of the year, I have my interest expense, I have my profit before interest expense, I have my interest income. I'm expected to calculate my operating profit. Now, the secret to this here is, generally when you are doing an income statement, you're working from the top of your income statement to the bottom to your final answer, which is your net profit. But in this case here, as you can clearly see, it is slightly different. You're given the bottom half, so in other words, you've got to work backwards to come to your answer, which is your operating profit. And when you are doing this here, remember, accounting boffins, we use the inverse operation. So when you're normally subtracting going downwards, when you're working an inverse operation, you're working backwards. Watch, this is what we do. You start off with your 48,300, right? So we have our 48,300. right? Because we are working backwards, I will now add the 500, because remember, if you're looking at this here, when you're working downwards, you're subtracting your interest expense. Now, you will add because you're working backwards. Your unknown figure is your operating profit, okay? That will then give you the 48,000, which is equal to 48,800. As you can see, it appears on your answer sheet. Right, now you come to your interest income and you say, because you add your interest income, when you're working backwards, you subtract minus the 350 will then give you your 48,450, which is your missing figure here, 48,450. And there's your calculation as to how you calculated A. So what do you remember from this calculation is when you are working from the bottom to the top of your calculation, you then use an inverse operation. So when you normally subtract going down, you add going up. Important technique to be used in all accounting activities whenever you are faced with a question of that nature. Okay. They're telling you that the business uses a markup percentage of 60% on cost. Once again, remember, whenever you are given something like this, this is what you do. Cost price, markup, selling. Cost is 100, markup is 60, selling is therefore 160. Right. Okay, we know that. Now they're telling us, here's my information, there's my sales, budgeted for September, actual for September, budgeted for October. You are expected to calculate the budgeted figure for October, but you are expected to calculate the cost of sales. Okay, what do we do here? Immediately we know that you take your sales figure, which is 198,000. Let's do that. So 198,000 is my sales figure, and you apply what I showed you here, saying you want to calculate the cost price. What you want to calculate, you put on top, therefore, times 100 on top over the selling price in terms of my formula was 160 over 160. And you can see that if you do this here, let's do the calculation. It says 198,000, 198,000 times 100 divided by 160, and you will get a figure of 123,750. Watch here. There we go. Watch. The operation, 198,000 times 100 divided by 160. You remember the calculation once again? There we go. Your cost price is what you want, so you put it on top over your selling price. This is just a technique that you can use when you are calculating your cost of sales. Once again, cost price over your selling price times 100 over, times your actual selling price, in this case, 198,000. Okay. So therefore, it's 198,000, which is my selling price, times 100 divided by 160 will give you a figure of 123,750. We can actually go now and slot in that figure into my budget period, and you can see it's sales less your cost of sales. So, in other words, if this is what is required, then your gross profit would be, let's do this one here. It is 198,000. So let's take the 198,000, 1, 2, 3, minus your cost of sales, which was 123,750, 123,750, and this will then give you your gross profit of 74,250. All right? So we got 74,250 as our gross profit. Okay, let's move on to the next slide. Now we are told in the additional information, we have salaries and wages. The cleaner will receive an 8% increase in October 2020, right? So the cleaner's salary will be increased by 8% with effect from the October. The business employs a sales manager and an administration manager. The sales manager earns 600 Rand more than the admin manager, that is per month. The managers are entitled to an increase of 7% from the 1st of October 2020. That's the information that is provided to us. Okay, in terms of my calculation now, here's my wages of my cleaner. Watch, we know that the cleaner will be subjected to an increase, so immediately we say fine, let's look at the cleaner first. The cleaner will receive an 8% increase, therefore, this is what we do. Take your 2,100 times the 8%, which is the increase amount, will give you a figure of 168, okay? Then obviously add that with the previous salary to give you a figure of 2268. Now watch this calculation, very important guys. You want the new salary of your cleaner. So if you want the new salary of the cleaner, what do? We take the existing salary, which was 2,100, okay? So we got the 2,100. Take the 2,100 and then, obviously this was the calculation, where 100% was in terms of percentages, plus 108 will give you the 2268. The point that I'm trying to illustrate to you here is, take the previous salary, which was 2,100, okay? And if we take the 2,100 now, and we say, fine, the old salary was 2,100 plus the 168, which was the increased amount of 8%, will give you a figure of 2268. So this becomes the new salary of your cleaner. As you can see, you take the old, which was 100% in terms of my calculation, plus the 8% increase. So that's just another way of doing it, but I've shown you on the calculator. You take the 100% plus the 8% will give you the new salary of your cleaner, which is 2,268. Okay. So if you look at your projected income statement now, you can see that the new figure that you need to slot into your projected income statement will be the 2,268 Rand as a result of the increase of 8%. Okay, the next one. So the cleaner is done and dusted. We sorted it out. The business employs a sales manager and an administration manager. So there are two managers that are employed by the business. The sales manager earns 600 Rand more than the admin manager per month. The managers are entitled to an increase of 7% with effect from the 1st of October 2020. Okay, let's do our calculation. Step number 1. Take the existing figure that we have here. Here we go. The salaries of the two people together was 20,000. The first thing that you do is you take your 20,000 and minus the 600. Okay? Why? Because both of them don't earn the same salary. One earns 600 Rand more than the other. Once you've done that, you will see that if you take your 20,000, there we go, minus the 600, that will give you 19,400. Divide that by 2. Now you can see that the one salary obviously is different to the other one. So the 9,700 is the person who is earning less than the one who was, obviously one earns 600 Rand more than the other. Right, now take your 9,700 that you have there. Okay, take your 9,700 that we have, that we've calculated, add the 600 to it. Why? Because obviously the one is earning 600 Rand more than the other. So the 9,700 plus your 600, that's the first part of your calculation. Okay, so here we go. Take your 9,700 plus the 600, and that will give you a figure of 10,300, right? Now increase that by 7%. Okay, so we say 10,300 times your 7%, and that will give you a figure of 721. Okay, so let's take the 9,700 that we have there plus the 9,700, and you will see that you're getting the salary for one person of, let's just check our calculation again, maybe we left out something. It's the 9,700 plus the 600, 9,700 plus the 600 will give you that figure 10,300 times your 7%, okay, and that will give you 721 plus, let's add the components, 9,700 plus the 600 to give you a figure of 11,021. Okay, so remember these calculations. What's important when you are doing these calculations to actually determine what was the salary prior to the increase. In this case here, going back to this calculation, just for clarity's sake, take the 20,000 that was given to you here, right? There's your 20,000 minus the 600, because they gave you the salary of both the managers, right? So remove the 600, you now have made them both equal. Take the 9,700 that you've calculated, add the 600 to it, okay? And then increase that amount by 7%. As you can see from our calculation, the final figure that you get for a salary of one of the managers will be 11,021. Okay, so if we look at this segment and we recap all that we have done in this segment. Number one, a projected income statement will always indicate to us the projected profit or loss that we anticipate to make in the budgeted period. Number two, when you are working with a markup, always remember it's your cost price over your selling price times your actual selling price to determine your cost of sales. And then you take your sales minus your cost of sales to give you your gross profit. And then when it comes to increases in your budget or decreases, don't always assume it will be increases, take the original figure, and from your original figure you work out the increase or the decrease in the budgeted period. Okay guys, when you come back, we'll continue analyzing and interpreting a projected income statement. See you just now. Welcome back, accounting boffins. Remember, we're busy analyzing a projected income statement. Okay, so our emphasis here is on our projected income statement. Remember, we're doing this here. So we are busy analyzing a projected income statement. Here's the information that we have. Right, in the additional information, we are told that your rent income increased by 9% on the 1st of October 2020. Okay, now look at the variation in the question. You are given the rental for October already. You are expected to calculate the September rental figure. Notice, in previous questions, you were given the September information, you had to calculate October information. Now, it is totally different. You are given the October information, and you are now expected to calculate the September information. Right, let's do that. Okay, this is what we do. Firstly, we know that the October figure of 10,028 is equal to 109%. Right? Why do we say that? Because obviously it has the increase built into it already. Therefore, this 10,028 is equal to 109%. What are you calculating? You want to calculate the rental prior to the increase, before the increase. So obviously, before you increase, your rental was 100, and therefore that serves as your unknown. Watch my calculation. Cross multiply. You take 10,028 times 100 divided by your 109. Let's do that. So it's 10,028 times 100 divided by 109, and you're going to get a figure of 9,200. So what is the 9,200? Your 9,200 is your 9,200 will be your rental for September. So in other words, if we have to complete this table, you can see that that is your 9,200, which was your increase. It was your rental prior to the increase. If you want to check on it, certainly you can do that as well. And that all that you do is you take 9,200 times the 9%. Watch, you're going to get a figure of 828. Add that with your 9,200, and there we go. 10,028 is the figure that you're getting as your increased in your rental. So in this particular instance, you have to use the increased rental to work out the rental prior to the increase. Okay, next one. Here goes. What do we have here now? We're expected to calculate. We are told with regards to our credit sales comprise 80% of total sales. First proviso. Sales are expected to increase by 10% per month and then by 12% during November 2020. Okay, what are we expected to calculate? Let's do our calculation here. Calculate the total credit sales expected in November 2020. So that's our calculation. Watch, this is what we do. You start off by looking at your October sale. Your October sale is 198,000. So you take your 198,000 times 112. Why is it 112? Because the increase is 12%. Let's do that. Okay? So you start off with your 198,000, right? Times the 12%, which is your increase amount, and you get a figure of that plus the 198,000 to give you a figure of 221,760. Remember, that's just your total increase in your sales. Now, because credit sales amounts to 80% of that figure, what we now do is we multiply that by 80%. Watch. And that will then give me my figure of 177,408, 177,408. That becomes your expected credit sales for November. You could also work with your September actual figures, right? And if you're doing that, then what do? Watch, it's 195,000 times the 10% increase, and then a 12% increase, and then 80% of that figure. So in other words, if this is what we're going to do here, watch what we're going to do. It's 195,000 plus your, let's do this again, times your 10%, okay? And that will give you a figure of 19,500 plus 195,000. This will then give you a figure of 214,500, right? Now we say 214,500 times your 12% is 25740. If you add that figure to your original figure, which was plus the 19,500 plus the 195,000, okay? And that gives you that figure times 80%. Here we go. We get a figure of 192,192. So in other words, if you used your September figures, that means you have to go back 2 months, right? Then, what was the proviso? Our proviso was, if we look at the proviso, they told us that sales was going to increase by 10% and then by 12%. So therefore, there's your 10% increase from September to October, and from October to November was a 12% increase. So in other words, if you used, or not if you used, we actually used the October figure here, and you can see it only resulted in the 12% increase to give us our 177,408. But if you use September figures, you have to first calculate the 10% increase, and then the 12% increase, and then the 80% to give you your total expected figure in terms of your credit sales. Now remember, why are we multiplying by 80%? Because it is expected that credit sales will be 80% of your total sales. So, once again, look at the requirement of the question. The question said, calculate your projected credit sale for November. And based on that, this is the calculation that we have to do. Okay, next one. You are required to calculate the cost price of the new vehicle that was purchased in September 2020. Let's look at the information that we have. We are told a delivery vehicle was purchased on the 1st of September 2020. Vehicles are depreciated by 15% per annum on cost. The accountant did not take this into account when preparing the projected income statement for September 2020. Okay? Let's see what we have here. You have your September budgeted figure of 6,200 and the actual figure was 9,000. So clearly there's a discrepancy, right? Or like we alluded to in previous lessons, we said there's a variance, there's a difference between your actual and your budgeted. Okay, now watch the procedure. This is what we do. Firstly, take your 9,000 minus the 6,200. The difference between the two will give you a figure of 2,800, right? So the difference in depreciation amounts to 2,800, okay? Multiply that by 12, okay? And then calculate 15% of that figure. Why? Because our rate of depreciation was 15% per annum on cost. Okay, so let's do that. Here we go. Firstly, we said, take your 9,000 minus your 6,200 will give you a figure of 2,800. Multiply that by 12 will give you a figure of 33,600. Now, watch this here. Your 33,600 is equal to the 15%, which is your depreciation. You want to know what was the figure on which it was calculated. So here we go. 33,600 cross multiply times 100 divided by 15. Can you see? Let's do that calculation for you. It is 33,600 times 100 divided by 15, and that will give you a figure of 224,000. Now, what is the 224,000? The 224,000 will be the value of the new asset that was purchased, or the new vehicle that was purchased in September. And how did we come about finding out this? Because the depreciation figures that we budgeted for and what it actually was two different figures. As a result of that, we went back using the depreciation calculation. We were able to calculate the value of the new asset that was purchased. So clearly you can see when we did our actual depreciation calculation, it was done on all the vehicles, including the new vehicle. Right, so what do we see here? Once again, just to recap on this one here, we're using our depreciation as our calculation. We took our actual minus the budgeted. It gave us a difference. We took that difference and multiplied it by 12. Reason, that was only for 1 month. That's why we're multiplying it by 12 to give us the annual figure, right? Because your depreciation is 15% per annum, and that's important. So times your 15% will give you the actual figure that you calculated here, the 33,600, was your depreciation at 15% per annum. You then went back to calculate the original cost price, and that gave you a figure of 224,000 Rand. Okay, so this is how you analyze a projected income statement. This is how you go about doing your calculations based on information that you have. All right? Okay, so when you come back to us, we're going to do more questions regarding analyzing a projected income statement. Let's take a quick break, let's refresh, and see you soon after the break. Welcome back, accounting boffins. Yes, we are busy analyzing a projected income statement. Let's look at the next question, and we are told here that that's the information. We're dealing with a bookkeeper, and the information that we have here is that comment on the control of the telephone. Let's just get that right. Okay, we're commenting on the telephone, where we are, yes, dear. Right, comment on the control of the telephone and the water and electricity. What advice would you offer to Zanele? State 1 point. Okay, firstly, look at the information that we are analyzing. We're looking at telephone, water and electricity, so that's the component. We budgeted 2,000 Rand. We actually spent 4,880, right? That's your October budgeted figure, as you can see, the same as your September one. Right, now, how will we respond to something like this here? 1, monitor the use of the telephone, water, and electricity. It is very important that we have controls in place to ensure that we stick within the budgeted amounts. Obviously, when we budgeted those amounts, we took into consideration everything that we needed to. However, there may be certain items that we did not consider. For example, a sudden increase in electricity tariffs. Okay, you may have budgeted for a 5 or 7% increase, but there was suddenly a 15% increase. Okay, your budget, can you see? I've already alluded to this point here. Should provide for any increase in tariffs or usage. So when you're drawing up this budget, take into consideration tariff increases, take into consideration, for example, looking at the telephone, you may be embarking on a telesales, an aggressive telesales campaign. So obviously, this will result in an increase in the telephone as well, right? Try and keep your records up to date. Check your budgets should be based on past usage. Like I told you in previous lessons, I'm going to mention it again. When you're drawing up your budgets, you're taking into consideration past usage. So in the previous month, if you spent X amount of money, you use that as your basis, and then you work from that. That's called historical cost budgeting, right? And then one is to have a negative variance, but investigate the reason for the negative variance. Why do we have the negative variance? So taking all of this into consideration, it is important that when you're analyzing, you have an action plan in place to ensure that we have done the necessary, we've analyzed our figures, and now we're taking action based on the information that we have available. All right. Zanele wants to reduce the maintenance budget to 500 Rand per month and then use the saving for staff training. What should she consider before making this change? State 2 points. All right, let's see. Firstly, look at your maintenance budget. You budgeted an amount of 5,000 Rand, okay? You spent, your actual spend on this budget was 2,000 Rand. Although it's a positive variance, you can see she did not use the entire maintenance budget. There was a balance or a positive variance of, clearly you can see, 3,000 Rand, right? So she budgeted 5,000, she spent 2,000. Now, watch. Her actual maintenance expenses is far more than 500. She's actually spending 2,000 Rand. So already you can see that the amount that she is spending exceeds the amount that she wants to spend. For example, she wants to spend 500, but she's already spending 2,000 Rand. Then, obviously, she will be under budgeting. She will be under budgeting. Maintenance will be neglected. When you neglect maintenance, it has long-term disastrous effects. Because if you don't maintain your land and buildings, your properties, your vehicles, your equipment, whatever else needs maintenance, if you do not maintain, you can have disastrous consequences for the future. Right? And also, it would mean that you have to replace old equipment sooner. Because if you're not maintaining that equipment and the equipment is reaching the end of its useful life, it would mean you'd have to replace equipment. And obviously, you know, the cost of replacement is very, very expensive. Yes, we do know that there are definite benefits of training and also the impact thereof on the use of machines. It would be irresponsible to reduce an important and a necessary expense by so much. Right? She's budgeted 5,000. Take this into consideration. She's budgeted 5,000. She spent 2,000. Right? So there's your budgeted amount. There's your actual amount. She wants to now reduce it to 500. You can look at the difference between the budget and what she wants to. Look at the difference between the actual and what she wants to reduce it to. So clearly you can see that although training is very important, its cost should be compared to the impact of a reduction of regular maintenance. Yes, by all means, put staff training into operation. It's very important, but not at the expense of cutting down your maintenance budget to such a level where you obviously are not going to be doing justice to the maintenance of your equipment. Right, you have a new competitor who started operating in a nearby shop, and obviously it's creating a bit of a stir for Zanele. So what was her response? Let's see, how did she respond by the competitor becoming a competition for her in terms of her business? Here we go. There's your motor vehicle expenses. You'll notice that we had nothing, and then obviously there was 4,000. Admin expenses, look at the difference between the two. Look, telephone, we've discussed that one already. Insurance, advertising, depreciation, we've discussed. So clearly you can see here that we bought a new vehicle to do deliveries, right? And your vehicle expenses went up to 4,000 Rand and your depreciation increased. Watch, you had a zero budget for your vehicle expenses, but because of the competition, because of the new vehicle that you bought, clearly you can see the expenses went up to 4,000 Rand. Not only that, your depreciation increased from 6,200 to 9,000 Rand. So this was a conscious decision to buy a vehicle to do what? To do the deliveries to our customers. And as a result of that, you can clearly see your vehicle expenses increased from 0 to 4,000, and your depreciation also increased. I think it was from 6,200 to 9,000 Rand. So obviously this is now impacting on our profits. There was a reduced markup from 60% to 30% in terms of your figures that are given to you. You can see that you reduced your markup to increase your sales. But now remember, by reducing your markup, you may increase your sales, yes, but this will result in your gross profit decreasing. Why is that? We know that selling price minus your cost price will give you your gross profit. And even once you decrease your cost price, right? If you decrease your markup, then it means that your profits will decrease because you're marking up at a lower percentage. Clearly you can see a reduced markup led to although an increase in sales, but a decrease in your gross profit. What about advertising? Let's look at advertising. Advertising, you budgeted 2,400, but you actually spent 9,600. So clearly there was an aggressive advertising campaign because of the competitor. You now had competition, and because of this competition, it has resulted in a substantial increase in your advertising. Again, your advertising costs have increased, and as a result of which you now have a bigger expense for advertising. Okay? We've discussed that time. In fact, your advertising increased 3 times more than what you budgeted for. Okay. If you look at your sales figures, sales and your cost of sales, you're going to notice something very peculiar or something very important for you to comment on. Now, remember guys, this type of question expects you to analyze the information. And by analyzing the information, you can clearly start drawing certain conclusions. Zanello's efforts were not successful because even though the sales increased, the gross profit decreased. Let's look at it here. Watch. If you look at your, let's do this calculation here so we can see what we're talking about. If we take the 180,000, right, which is your selling price, minus your cost of sales of 112,500, this will give you a 67,500 profit. We're looking at 67,500 gross profit. Okay, let's take that further. Let's do this one here. 195,000 is your actual sales figure minus your cost of sales of 150,000. Clearly you can see here 45,000. Right. So, watch. Important. Your sales increased from 180,000 to 195,000. But at the same time, your cost of sales increased from 112,500 to 150,000. Okay? Therefore, this means that your gross profit has actually decreased from 67,500 to 45,000. Okay, and clearly now this strategy has not worked for her. As you can see, although the sales increased, your profits actually decreased. Okay, now here's our response. Zanella's efforts were not successful because even though the sales increased, expenses such as cost of sales, vehicle expenses increased significantly. And therefore, you can see that based on the actions that she has taken, it has actually resulted in a decrease of our profits. Right. So, based on the information that we have, let's just illustrate this just to make it clearly evident to you that yes, her action resulted in sales increasing. Definitely. The sales that you budgeted for was 180,000, but the actual sales were 195,000. However, that change did not give us the desired effect. Why? The idea to increase your sales is to increase your profits. But as a result of all of this here, notice what happens. Notice what happens here. That yes, the sales increased, but your cost of sales increased, right? And if your cost of sales increases, your gross profit decreases. Remember, when cost of sales increase, the gross profit decreases. Also, your vehicle expenses increased, right? And remember, not mentioned here, but we discussed it, your advertising also increased. So that expense also increased. Okay, guys, we've done an intensive lesson on the interpretation and the analyzing of a projected income statement. What's the way forward? The way forward is for you to start doing as many activities as you can get your hands on to improve this skill of yours, and practice, practice, practice. Because if you do that, I promise you, you're going to be a shining star, an accounting shining star. Until the next time, goodbye.